think the big issue here is that the cycle is basically beginning, to swing, to turn or get towards the peak. And that's clearly a critical factor. Now, if you put that in, or as I've shown in this third slide, this is looking at where we are against a normal cycle. Now, this is not set in stone, so we've got to be careful, and we're just playing the averages here. But, the averages are important to watch as a benchmark. And that dotted line is the average cycle since 1970, the average liquidity cycle. And, our view is that liquidity drives markets. And so you've got to be aware, alert to this. And the red line is the current cycle. Now, we're not turning down yet. We're not that's not the point. Maybe we've got a little way to go before we reach the peak. But you can kind of see that, put in context, this is the situation that we're trying to grapple with. Now, I put in the earlier slide, which was the world one, so adding back China, a projection. And that projection is showing that we reaching a peak, maybe in 6 months, 9 months time, and then we kind of go down. Now, this is looking at the world. The index shown is a black line, which is our index of the momentum of liquidity through world financial markets. So this is the amount of money. This is not M2 or M1 or any of the monetary aggregates. This is money which is flowing through financial markets, which is really driving financial asset prices. And what we tried to show there is that there is a rhythm, a pretty standard rhythm of about 5 to 6 years in that cycle. And the sine wave that we've drawn on top of that was actually drawn up 25 years ago in the year 2000. And we haven't changed it thereafter. It was done by Fourier analysis for those that are mathematically inclined. But it's been sort of continued on at the same frequency, which is that 65-month tempo. And what you've seen over the course of the last cycle movement is that we've been absolutely on track. So the cycle bottomed in October of 22, and it's been moving up. The volatility you've seen is actually largely a China phenomenon, and I can try and show what that looks like if you take a look. Hopefully that slide has changed to the advanced economy stripping out China, and you get a much cleaner line. Now we can drill into what's going on in China if you like, but I think the big issue here is that the cycle is basically beginning to swing, to turn or get towards the peak, and that's clearly a critical factor. Now, if you put that in, or as I've shown in this third slide, this is looking at where we are against a normal cycle. Now, this is not set in stone, so we've got to be careful, and we're just playing the averages here. But the averages are important to watch as a benchmark, and that dotted line is the average cycle since 1970, the average liquidity cycle. And our view is that liquidity drives markets, and so you've got to be aware, alert to this. And the red line is the current cycle. Now, we're not turning down yet. We're not that's not the point. Maybe we've got a little way to go before we reach the peak. But you can kind of see that, put in context, this is the situation that we're trying to grapple with. Now, I put in the earlier slide, which was the world one, so adding back China, a projection. And that projection is showing that we are reaching a peak, maybe in 6 months, 9 months time, and then we kind of go down. And the question is, why do we go down? And that's an important thing to address. So let me try and address the reason why we think things may be going down. Now, one of the arguments is to look at this slide, which is comparing the current cycle shown in orange here with the cycle back in the 1980s. Now, a lot of your viewers probably won't remember the 80s or whatever, but that's when I started in financial markets, and I remember the 87 crash all too well. I was at Salomon Brothers at the time and witnessed it sort of front on. Basically, what you saw was a very similar move to what we're seeing right now. You had a Plaza Accord in 85, which was an attempt to get the dollar down, and just think back to the word accord, Mar-a-Lago Accord. Whenever politicians or policymakers talk of accords, they're talking about sizable exchange rate adjustments, and we've had that. That allowed foreign central banks back in 85 and again now to ease policy, and that was a factor which drove global liquidity up. It launched a recovery in the world economy. Rising commodity prices, we're sort of getting that now. It began to push yields in bond markets higher. We're getting that now. And it was ended basically in late 1987 by the Germans saying that they were concerned about inflation and they were thinking about and planning to raise interest rates. The crash stopped them doing that, but that was their intention. And because of the Plaza Accord and Louvre Accords, there were set, if you like, trading bands between currencies and between interest rates. So if the Germans moved, the US would have to move. And Treasury Secretary Baker at the time was actually much more inclined to want rates lower, and a little bit like, the Treasury and the administration are talking to the Fed now, get rates down. That's what Baker was doing at the time. And in the event, things went awry. Investors got spooked. They realized the liquidity cycle was about to end. You can see the dramatic move down in that red line at the time. And that's really what happened. That caused the crash. Now, the orange line is moving up in that direction. So your concerns about, bubbles and high PEs are very well said, because this is what we expect at this stage of the cycle. We may not be there yet. We haven't had the trigger, but we're clearly getting late in the cycle. And those are things to think about. So try and articulate why you could be getting this cycle ending sign. And what I want to do is just to move on, if I can, in this presentation to another slide. I'm just going to go through these bits and get to the bit I want to start with, which is just here. And that's saying that, this is what we've got to think about in terms of understanding risk in financial markets. And this is looking at the ratio between debt, shown here for all advanced economies, and the amount of liquidity they've got. So in other words, the ratio of debt to liquidity. Now, why is this so critical? The reason it's so critical is that debt has to be refinanced. Okay, it always has a maturity. So if you issue 5-year debt, in 5 years' time, you've got to refinance that debt or pay it back. The spoiler alert is that debt's never paid back. It's only ever refinanced. So what you get is a need to refinance periodically. And what this chart is basically showing is that ratio between debt and liquidity. If you get lots of debt relative to liquidity, you're going to struggle to do the refinancing. It's much more of a problem. And what I've shown is that when you get above that threshold of about 2 times of that ratio, that dotted line, you get financial crises, which we've annotated there. And almost every financial crisis, if you look back, has been a debt refinancing crisis in some way. If you look at the other side of that threshold, when you're very low, there's lots of liquidity. Liquidity becomes abundant, and its vent is financial assets. It creates asset bubbles. Now, if you look at the last 5 to 10 years, we've labeled that the everything bubble. Why is that? It's there because you've got excessive liquidity relative to debt for 2 reasons. I mean, one is that every episode of crises or tension in the world economy, be it COVID or be it the GFC, policymakers come in and just throw liquidity at the system. They need to stabilize it. They don't want, the risk of a credit crisis, a serious one. So they throw in lots of liquidity. And then the other thing they did, particularly around the time of COVID, was to put interest rates down to near zero levels. Well, that just encouraged everyone to term out their debt. And people were basically terming debt out in 2020, 21, 22 at very low interest rates, but they were terming it out 5 years later, let's say, in 26, 27, 28. And that is now likely to come back onto the horizon. Now, you'll see that in this chart, which is showing the change in the average debt roll. And look at that bunching around the end of the decade. There's a lot of debt to refinance. That could be household debt, syndicated loan debt. That's debt of high yield bonds. That's government debt. Everything sort of, coming out into that concentrated period. And the reason this is so unusual is that, when I was at Salomon Brothers in the 80s and early 90s, the Bible that everyone looked at and read was a book called The History of Interest Rates by Sidney Homer. And that book, which is sort of the Bible of interest rates, goes back, 4,000 years. Nowhere in that book is there any mention of zero interest rates. So in 4,000 years, we haven't had it, but we did have it in COVID. Even negative rates, in fact, as you'll recall. And that's why it's so unusual. And that's why we're kind of recovering from this mess, because basically that incentivized everybody to take on more debt and term out their existing stuff. And this is the problem that we're creating. So what you're getting is this debt roll. The other thing that I'm going to say, which kind of hooks into your point, your very good point about AI, is that a lot of the liquidity that we've had in the system over the last 5 years or so has come through the big tech firms in the US who have generated vast cash flows. They haven't invested them particularly. They've basically kept them in Treasury. They've been out there in the money market seeing if fueling liquidity. But now the tech spend is eye-wateringly large. I mean, from the latest figures I saw, the tech companies are spending $1 billion a day on new capex in AI or whatever. So you're talking about over a 2-year period, probably as much as $1 trillion of new capital spend. And that is clearly money that is coming out of financial markets. Money that's anywhere must be somewhere. And the fact is, if it's in the real economy, it's not in financial markets. And that's the reality. So you get to this slide that I've just put up here, and that's saying this is the problem that everyone's got to start thinking about. This is the debt liquidity cycle. At the heart of the system is this collateral stability requirement, which is saying that, the US Treasury market is absolutely key here. We've got to have a stable Treasury market. That's why you've got the Fed and the Treasury geared up, I think, to maintaining volatility, a low volatility. And the way that you can understand that is to look at that left-hand wing, which is how debt is converted into liquidity, because basically you need high-quality debt to create liquidity. And what it's saying is that the repo collateral markets are absolutely central here, and you've got to look at things like the MOVE index or the or SOFR spreads. And here are sort of just two examples. This is looking at SOFR spread. So this is saying, is there a shortage of good quality collateral in the system or a lack of liquidity? And this is showing when you get spikes. Now, there's been a lot of spikes or a lot of activity in the last 12 months. So you can see that, if this is looking at the pulse of a patient in a hospital, you can see that they're getting pretty excited here. They're moving up towards a coronary or whatever it may be. But, this is the thing. The Federal Reserve is onto this, and they're trying to keep these rates down as best they can by changing bank reserves. And that's why I think that it's going to be really, really tough to rebuild the TGA in the next 6 months without there being a serious problem. So I trust the Fed is onto this. And so that's why I think there needs to be, some fundamental change in their operating procedures. And here's the MOVE index, just to show what's been going on. I've been arguing this point about MOVE volatility coming back into this range and there being a target. And I was accused, I think, in one of the financial newspapers, maybe it was the FT a few days ago, of sort of launching a conspiracy theory. I don't think it's a conspiracy theory. It's just a fact. I mean, it makes absolutely every sense in the world for the Treasury and the Fed to target volatility, because hedge funds are key buyers and the collateral markets are critical. So why not? So, that's the story. That's the risks that people face, I think.
Yeah.
But we're not over yet. The fat lady hasn't sung.